Good afternoon and welcome to BizTech Midday Market Watch. Our guest today is David Kuo, the co-founder of the Smart Investor in Singapore. Welcome to the show, David. Great to have you.
Thank you, Brian. Yes.
Now, David, there's a lot of uncertainty in markets right now. And particularly, there's a real disconnect between Main Street and Wall Street. So essentially, the real economy and markets. Now, where is the smart investor putting its money to work in the long term?
Well, the operative word, Brian, is the long term. And I think the smart investor always has a smart plan. In other words, you have to forget about what is going on at the moment and focus on sometime in the future. And ultimately, there are only four places, Brian, literally only four places, four asset classes that you can put your money into. It is either cash, bonds, properties, or shares. Now, you might want to interject and say, what about Bitcoins? What about gold? Now, they are not asset classes. There are only four asset classes. And an asset class is something that you invest in that rewards you with income for holding it. So in the case of cash, you get interest, well, hopefully. In the case of bonds, you get a yield, hopefully. In the case of property, you get property yield. And in the case of stocks and shares, you get dividends, right? So those are the only four asset classes that you have to put your money into. And the smart investor always works according to what we call the rule of 100. Now, the rule of 100 says you take 100 minus your age, and that should be the amount of money that you put into the equity, into the stock market. So if you're a young person, 20 years old, 100 minus 20 is 80. And so therefore you put 80% of what you have into the stock market. As you get older, you will put less in the stock market and more into those safer instruments such as cash. Now, I will group cash and bonds together, and I will group property and equities together. So ultimately, what you have to do with your money is to say, in my case, I am 60 years old. So technically, I should put 40% of my money into equities and 60% into near-term cash. So either bonds or cash itself. What has really changed is that the money that you put into bonds and cash is not really rewarding you a great deal. And also that rule of 100 that was set many, many years ago was based on people having a lifespan of about maybe 70 or 80. But my dad is 93 years old now. Wow. So what is happening is that we are all living longer. So we have to make some minor adjustments, but not serious adjustments. But that gives you a kind of blueprint, Brian, that if you're around sort of 50 years old, half in cash, half in equities, and forget about what is going on as far as the market is concerned, because we are ultimately long-term investors, and we have to believe that this pandemic and what is going on, this turmoil in the market, will eventually go away.
But you know, just to follow on what you said in terms of, and let's just say a 50-year-old person, and puts a 50-50 split in terms of stocks and then near-term cash, as you put it. Given the scenario right now and all the uncertainties in markets and the heavy weightage of markets now towards stocks, particularly tech stocks, what's your view on that?
Well, there's nothing wrong with tech stocks, but again, we go back to the smart investor. And what you need to do is to make sure that if you are going to be invested in equities, you need to make sure that your equity portfolio is balanced. And the balancing that I try and sort of explain to the people on our Smart Investor website is to say that of those equities, 60% of them should be in income shares. And these are shares that are very stable, they tend to be very boring, and they don't really do an awful lot in terms of giving you capital growth. So that 60% of your equity portfolio should be in income shares. 30% should be in growth shares. And these are companies that may not pay you an awful lot in terms of dividends, but they do grow reasonably quickly. And so 60 plus 30 gives you 90. That leaves you 10% of what I call speculative shares. And these are the kind of shares that you can put your money into that may do very well. Again, they may not do very well. So they're exciting shares for your portfolio because ultimately equity investing should be interesting for people. And if you have all of your money into these really staid, very solid income producing shares, it's not going to get you out of bed in the morning to go and have a look at your portfolio. But if you do have some growth shares in there and also have some speculative shares in there, then it makes equity investing exciting. So going back to what you're saying about those tech shares, they kind of belong in the 30% of the fast growing shares, and some of them may even belong in that top 10% tier of speculative shares. So that is the way I look at equity investing. You have this solid base, which will produce that income for you all the time. You have that 30% exciting growth shares and the 10% speculative. And the speculative shares don't work out, Brian. It's okay. It doesn't matter. It's not going to ruin your life,
Yes, of
because it's
course.
only
Yeah.
10% of your entire portfolio.
And also, one of the things that I think in these markets we've got to look at is dollar cost averaging, isn't it? I mean, it's a general rule, but particularly in these volatile markets, you're not going to time the market. So you literally need to dollar cost what you're doing.
Oh, you absolutely have to. And that is why if you have a portfolio of shares, and remember that 60-30-10 split that I have, if you have around sort of 20 different counters in there, 20 different companies in there, there will be plenty of opportunities for you. And if you have a $100,000 portfolio and it produces, say, a 3% yield for you, you should be getting around sort of $3,000 a year in terms of the dividends from that portfolio.
Yeah.
That works out to be about $300 a month. So when you get enough cash in that portfolio, what you should really do is to put that money back into the portfolio as quickly as you can, because the sooner you go and buy those counters again, the sooner you go and buy those shares, then in either 3 months, 6 months, or a year's time, you'll be getting even more income. And if you build your portfolio correctly, you should be able to get that portfolio to grow at around sort of 10% a year. And that is ultimately crucial, because if a portfolio can increase its value at approximately 10% a year, it means that you're going to be doubling your money, doubling your investment every 7 years. So your $100,000 portfolio will become $200,000 in approximately 7 years' time. And in another 7 years' time, that 200,000 will become 400,000.
Yes.
So the sooner you start, the sooner your portfolio will start to grow. And before you know what's happened, Brian, you've got $1 million portfolio. And then you can start to relax a little and then rebalance that portfolio again, according to your rule of 100, and keep on looking at that. And that is really the way that people should be thinking, rather than to go jumping in and out of the market all the time, hoping to make a little bit of capital gains. And in my case, Brian, I have never sold a share that I have ever bought. So going back, over 20 years of my investing, I have never sold one single share that I bought 20 years ago.
Okay, I'm going to ask you a question specifically, because I looked at your website and you have named 3 stocks that you're not going to sell: SGX, DBS Bank, and Nike. Now, they're not exactly names that are flavors of the month, but what do you see in these stocks?
Well, the mere fact that they are not flavors of the month is really why you should be actually buying them. What you don't want to do is to buy the stocks that everybody else is buying. So those are 3 of 100 counters, 3 of 100 shares that I have in my portfolios. And so therefore, I not only will not sell any of these 3, I will not sell the other 97 either, because they are all doing something for me. Now, if we have a look at the first one, Singapore Exchange. What is so wrong with Singapore Exchange? It has a 3% yield. You show me a bank account at the moment that will pay you 3%.
Yeah.
You'll be hard pressed to find one, Brian, unless you look for some banana republic somewhere. So if you have a choice of putting your money into those kind of bank accounts, or to put your money into SGX, I'll take SGX any day. I'll take that 3% yield anytime. So let's have a look at DBS now. Yes, banks are not flavor of the month, because people are very concerned that banks may have a lot of bad debts to write off. But as we have seen with some of the American banks, and more recently with Barclays Bank, they weren't that bad. I mean, sure, if you invest in banks, you have to accept the fact that banks are at the forefront of any economy. And when the economy is doing well, banks will make exceptional profits. But when the economy is not doing very well, then of course banks will get hit. And when they do get hit, yes, the investors will suffer to some degree. I mentioned Barclays Bank. I own shares in Barclays Bank. I've been bitterly disappointed that the regulator in the UK have told the UK banks that they cannot pay a dividend. I think, they should be allowed to decide what they want to do themselves. Who knows a bank better than the bank itself, whether or not they can afford to pay a dividend?
Well,
So
the
in the
thing
case
is,
of
I think, okay, that's where I disagree with you, David, because at the end of the day, we don't want a situation like in 2008 where the British taxpayer had to bail out the British banks.
that is not going to happen this time, Brian, right? Because they learned their lesson in 2008 through the great financial crisis.
Yeah.
And at the moment, you take a look at the banks. You want to put some money in the banks and you say, I'd like to open a savings account or a fixed deposit account. What interest are you going to pay me? I think the answer is zero, Brian. They're not going to pay you anything. Why? Because they are awash with cash at the moment. If we have a look at how much money has been created by the central banks around the world, it is somewhere in the region of $8 trillion US, right?
Yes.
They are awash with cash. So therefore, I think banks are okay. And I think banks are pretty sensible. They have lent money more sensibly now than they did back in 2008. So I think the balance sheets of the bank are looking good. Sure, there's going to be some bad debts. And when they do, the media will be all over it. Oh, sort of look at the bad debt provisions that the banks have made. But let's forget about the bad debt provisions. Look at the good debts that they have. And so therefore, I'm not too concerned about the banks. And if you have a look at some of the banks at the moment, in the case of DBS, is trading on a price to book of approximately 1. Some of the other Singapore banks are trading at a slight discount, about 20% discount. But the other banks around the world, in some situations, they're trading at a 40, 50% discount to their book value. And one of those is HSBC. But HSBC has problems of its own at the moment because it's trying to balance up what it's doing with regards to the East, China, and what it's doing over in the West, US. And it's just sort of caught in the middle of this crossfire between these two economies. But I think HSBC will come out okay. Sure, there's going to be some bad debts, but I don't think it's ever going to be in a loss-making situation. I hope. But what it may do is to produce lower profits now than it did a year ago, but nothing too significant.
And now, what about Nike?
What is wrong with Nike? You have a look at Nike, and ultimately, in the case of Nike, it has got free cash flow in the region of $3 billion, $4 billion US, free cash flow, right? The dividend yield is low. I admit that, right? Yeah. The dividend yield is less than 1%. So you would say, I'm not going to be investing in Nike for its dividends. But those dividends are growing at approximately 14 to 15% a year. So for those kind of investors, sure, you're not going to be getting a lot of dividends today, but if Nike is capable of growing its dividends at 15% a year, it will probably sort of double the dividends that you receive now in 5 years' time. So in 5 years' time, you're going to get twice as much in terms of dividends as you do today. So you need to be patient with these kind of companies if you are an income investor. But for now, Nike still has a tremendous amount of growth. So therefore, it stays in my portfolio, just like the other 97 companies will stay in my portfolio.
And you know what, especially in the Singapore context, REITs have been traditionally a favorite, both for institutions as well as retail investors. Stable, predictable earnings, strong dividends, and of course, capital growth. But the pandemic has changed things, and the changing market dynamics will change the attractiveness of REITs. Now, what is your view on this?
Yes, it's changed it to a small extent, Brian, but I was recently in some of the shopping malls that I have investments in. CMT, Capital Land Mall Trust, is one that I have money in. And sure, yeah, it is not doing as well as it did a year ago. But what is happening at the malls is that they are changing. They are changing the way that they operate. So the first things they did was to try and help out the tenants, because if you haven't got any tenants, you're not going to get any customers coming into your mall. That's a given. Yeah. So what they're doing is they're changing the mix at some of these shopping malls. There are more restaurants operating in there now. And if we have a look at Singapore specifically, I mean, I'll talk about some of the other REITs afterwards, but Singapore Singapore specifically, people want to go out, and it is very convenient to go out here in Singapore. Unlike some of the REITs, say in the UK or maybe in places like the US, where you have to travel miles to actually sort of go to the REITs. But in Singapore, it is unique. People like to go out. People live in big nuclear families. They want to go out and have dinner together. And where do you go? You go to one of the restaurants in one of the REITs. So I don't think I'm that concerned about, say, for instance, the retail REITs. The commercial REITs, the landlords, the people who are operating offices. Yes, that may change a little, but not significantly so, because people will be returning to work at some point, and people will be having to go back into the office. And when I have a look at some of the office REITs that have reported so far, Brian, their occupancy is around sort of 90 to 95%. So nothing really much has changed. I think what will change is that the way that we go into the office. I don't think the office will be full of people like it was before. I don't think we'll all be hanging around the water cooler.
But wouldn't that then be, David, it would result in a smaller footprint required in the office? Because if you have a 50% team that's working, you probably have a smaller footprint.
And you're going to have to socially distance as well. So the desks will not be crammed as close together as they were previously. I remember when I was working in the UK, the only thing that divided me from the person next door literally was my files, right? That is not going to happen anymore. And ultimately, people are going to be spread further apart. If anything, we're going to be needing bigger office spaces because we are going to have to socially distance. But I think what will happen is that they will be practical. Officers or the owners of companies will be practical, and they'll be saying that, yes, all of you can't come in at the same time, but half of you will come in, the other half will work from home, and then we'll just rotate, but we'll still have to keep the same amount of space as we did previously. Right. So that is the Singapore REITs. I need to also mention some of the other REITs. I mean, there is no one size fits all REIT, Brian. I mean, we have things like data center REITs. We have business...
and those will continue to expand, isn't it? And the reading that I've done basically clearly indicates that that's really a growth sector within the REIT industry, the data center REITs.
That is one of many. I mean, for instance, Capital DC REIT is very focused on data centers. We also have Mapletree Industrial Growth that operated business parks previously, but they are now moving into data centers also. So that sector is doing very well. And then there is another type of REIT, which is the one that I really like, and these are the telecom towers. And they, there are two of them over in America. One is called Crown Castle, the other is called American Tower. Now, what they do is that they operate these telecom towers that sit on land, and they are effectively real estate investment trusts because they own the property and they're growing at the rate of knots at the moment. I can't think of any REIT that is capable of growing its distribution in the mid-teens to 20% a year. That is how quickly they are capable of growing their distribution. So when you have a portfolio, sure, those REITs that you talked about, the likes of the retail REITs and the office REITs, the business park REITs, yes, they'll sit in that 60% tier of that pyramid of the shares that you own. Then layered on top of that, you've got these telecom tower REITs, the data center REITs, they'll be part of that 30%. And again, if you have a portfolio that is constructed in that way, it should be capable of growing at approximately sort of 10, maybe 12% a year. So don't put all your money into just those safe REITs, but instead have a spread of REITs and choose those REITs very carefully and balance that portfolio. And I don't think you're going to have too many sleepless nights.
David, thank you very much for your insights. We've been speaking to David Kuo, the co-founder of the Smart Investor in Singapore, on BizTech's Midday Market Watch. I'm Brian Fernandez. Check out www.biztech.asia for business and technology conversations.